The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, good to see you. Spring is in the air. Is spring in the market?
Hey there, Ian. Lovely to chat. Not only is spring in the air, but the sun is shining here in Hampshire, and we hope the markets can spread some of its largesse and happiness. Sadly, as we both know, markets rolled over in March, but all is not lost. So we've seen, in terms of the flow of funds, some interest in terms of the UK. The UK has a stable backdrop. We've got economic positives, negatives, bit of a curate's egg, but some great valuations. But the surprise probably is that Techmark is outperforming globally.
Hooray.
And UK is a great place to hide, if nothing else. Techmark year to date is plus 1.1%. Put that in context. S&P is down 3%. NASDAQ is down 5.8%. And Bessemer Cloud, yay, the Holy Grail, is down 9.5%. Meanwhile, we're outperforming and valuations just do not get in the way. Current sector PE somewhere around 18 times. Now, in addition to all of that, some of our smaller companies have been popping out some really pleasing news. These are names that you may not see in terms of your day-to-day, so keep on scrolling down in terms of the company list and you'll bump into one. Now, first one to bump into is a little company called SRT Marine. Ian, I know you'll know them because you're a sailor by trade. Just popped out with a pleasing H1 print of the highlights. Revenue was 26.2 million. Now, last year, the compare was 5.5. Now, you're immediately saying, George, have you checked the numbers? Is this correct? Yes, I've checked the numbers. SRT has been nailing contracts. In addition, PBT was 2.8 million, but that reversed a 4.6 million loss last year. Cash, 4.5 million. However, a receivables pile of 32.5 million. Stuff is starting to change, and the change driver here is a hoofing great big contract with the Kuwaiti Ministry of the Interior. Value on that was US dollars 213 million. Now have that. Also, in terms of smaller companies on the good news cycle, we had Microlise. Don't know if you know them, Ian. They do a lot of fleet tracking. A fallen star, they had a cyber attack on them, which dented customer confidence. And in fairness, the balance sheet as well, having to take a provision for this. And in fairness, the implications are still being worked through. However, nice print this week. They are winning new customers. Customer count was up 375, so winning customers at scale. The churn, which is something you would have been concerned about, that's flat at 0.7%.
That's flat having had a cyber issue?
That's flat through the cyber issue. Yes, absolutely. Revenue was also growing, as was ARR, plus just under 19%. The cup overfloweth, Ian. We also had Xaar. Now, Xaar is one of our precious research clients at Progressive. They also had a good print this week. Revenue was down 13% year on year. However, nice evidence of a burgeoning demand environment as they ink contracts with a whole array of OEM. And now we're starting to see those partners debut their new products. Sadly, however, I can't sort of get off the earnings wheel without just flagging up Computacenter. It was just over a week ago now, Computacenter failed to achieve its 20 years of unbroken EPS growth. That was a shame, really disappointing. On the positive, the shares rallied on the print. Nerves were fairly heightened going into it. I don't know who next will do 20 years unbroken EPS growth. Ian, do you have any thoughts on it?
I don't have any. I think every time you put your money on something like this, you're on for a loser. It's like one of those AIM awards. Well, 19 years of successive growth is pretty damn impressive stuff, particularly when what you've seen over those 20 years includes COVID and the global financial crisis. But what have I been looking at? Well, I've had a couple myself. I've had Gamma that I saw earlier this week. Great AIM success, it has to be said, over the years.
This is a big one, though.
This is a big. It is now. It has now gone to the main market. It has moved on to pastures equally green. The results: good underlying growth, enterprise business. Interesting comments about the lower end of their public sector business, which is actually quite small, but saying that there's a little bit of penny pinching going on there. But in the larger side of public sector contracts, no sign of any upsets at the moment. The main issue economics-wise for them is the exposure they have to small and medium-sized enterprises, which is the bulk of their end user base. There's sort of a lot of fingers drubbing on the table to try and work out which way the economy is going and where Rachel Reeves is going to drive the growth or allow the growth to actually happen. Big news, though, was Germany. We've had a couple of acquisitions from Gamma over the last few months. Thing called Placetel at the end of last year, and more recently something called Starface. And that means that put together, they've now got 500,000 seats of cloud IP telephony access in Germany.
Is Germany a good place to be investing in at the moment?
Well, we're back to the great tech defensive conundrum, aren't we? Is it a good place to be in when you've got a secular long-term driver like IP, internet, telephony, cloud telephony driving forward? That would say yes, but it has to be said that they've got a tough market there. And they're not seeing jolly customers, but they are actually delivering organic growth in that market. And given what they've done in the last few months with putting these businesses together, maybe a little bit ambitious to say they've got the same potential that they had when they floated back in 2014. The same setup they had in the UK, they now have in Germany, and they're now poised for growth. But we await Germany's cloud communications adoption, should we say, and we've been doing that for a few years.
It's a great point, Ian. Not to roll back on Computacenter because I'm still crying about it, but if we go back to the print there, Computacenter USA is now 40% of revenue. All the way back in 2018, Computacenter USA was 0% of revenue. I've got to say, I really like management teams that think about expanding the business in difficult times. And you're saying it's a UK template that they could drop into Germany.
Yes. It has to be said that these markets aren't all exactly the same. And when they did go initially into Germany, it was a bit sort of, well, it's Germany. They're terribly advanced and they're terribly sophisticated and they're going to be terribly on the front foot as far as cloud communications are concerned. Not quite the case. Germany is actually very conservative. Germany has a slightly different competitive scenario and also has nowhere near as good a telecom system. I know that's heresy when we all enjoy beating up BT so much, but it didn't quite work out for them at first in Germany. But when you look back at it, you think, actually, that's just classic. Germany's going to be great. Actually, Germany wasn't great. It should now, going forward, there's only so long you can avoid moving as a country towards cloud computing, cloud telephony. It's going to happen in Germany, and it's a big country.
On a really provincial level, if we look sort of one step away from where you are, so think about sort of the infrastructure IT service companies, although they're saying the market's hard, they're not saying the market's gone away. So, I mean, it is a thundering beast of an economy out there.
Yes.
They've got lots to do. Clearly, cars is...
Yes, there are big questions, but it's not a broken economy. I don't think there are.
Agreed. Absolutely. Yeah. Well done, Gamma. What's your feel in terms of the management team there? Are they up for it, for want of a better word?
Oh, yes. I think they are very much up for it. This is a management team that over the last few years, they've invested in Germany. They've invested elsewhere in Europe as well. And they've invested very cannily in terms of getting the right product access, in terms of being able to get to the right suppliers of product, and also playing around with some of their own technologies.
Yeah.
They position the business very well, and poised for growth it's a bit of a hackneyed phrase, but I think it does look a lot better in Germany than it has for many years.
Can I ask you to put your fund manager hat on for a moment, please? What's your take as a professional when you see a company moving from AIM to main? Clearly, if you're a banker, you say, ooh, Visa Rama, I like this. Yes. But if you're an investor, do you think they haven't fallen for that one, have they?
One of the curiosities is you are moving across, you're going to be spending a lot of money on things like prospectuses and lawyers and accountants, and this move across has caused a little bit of a problem for them, and they haven't been able to give us quite as precise guidance as they might have wished to, because they have to do everything in reference to a prospectus. Unless investors want to be particularly charitable towards the auditors and pay out amount of money to them,
Yes.
when companies make these moves across from AIM to the main market, it's going to be a little bit sort of shake the tin for the accountants, I'm afraid.
Yes, absolutely.
And accept that you're going to have a strange intermission as far as guidance. Not that it's a particularly big problem at the start of the year in a company that's got a huge ARR. Don't normally use that phrase with it, but 90% or whatever of this business is recurring.
Yeah. It's not the other thing, which is we think Americans would be trying to de-risk some of their portfolios. I mean, clearly on the back of positions of strength. And I wonder, if you're a main market, are you more attractive to Americans?
At 1.2 billion market cap, there are specialist US small cap guys that ring up and ask about these things, but
Yes.
it's not an everyday occurrence, should we say. This is part of the question, isn't it, for the UK small cap market? Get on and just do your job well. And as you say, making references to moving overseas and being international, just get on your front foot. Give the companies money to go and build a business in Germany or in France or in America. Other things going on, another little hero, well, it's not such a little hero really nowadays, is Judges. And you were talking about companies that can just keep going and keep going and keep going and building earnings. And
Yes.
Judges used to be that story, it has to be said. This is a great company based around instrumentation, scientific instruments. It goes out and buys businesses from typically private ownership, puts them into its own business, puts a little bit of its own sort of special sauce into it and around it, and grows. And it keeps doing that. It is what can be described as the scientific instrument equivalent of Constellation's software.
Wow. That's a big claim. Wow.
I have to, of course, point out that the scientific instrument market is substantially smaller than the global software market. But it's the same basic model. You go out and you buy businesses that don't look like they're going to take on the world, and you help them take on their little bit of the world.
Yes.
And you move them out of their private founder ownership into a public ownership structure where you've got slightly greater resources. You have got shared cost bases and such like, and shared expertise, access to distributors internationally. It just takes these businesses up another level. And that's what it's been doing for years. A couple of years ago, it made a major acquisition of a business called Geotech, which does non-destructive testing of geological cores. So you take your core sample out and it
Yes.
scans, looks at the core sample and says, this is what's in it. This is what the constituents are. It's a great business. They think it's got huge long-term growth because they believe there are going to be more and more countries and companies spending on finding out what's actually in their ground underneath their territories.
Is this including Greenland, or are the countries also available for this massive opportunity?
This massive opportunity is mainly concentrated around a relatively small number of countries.
Right.
It's only 4 or 5 countries actually spending money on it. And it's only something you can do on a couple of ships out at sea. That's proved problematic in that if you're on the contract or you're not on the contract, and sometimes they're not on the contract. And as we know full well from our own experience and some of the companies we've spoken about already, if you miss out on a contract or a contract gets delayed, it hits the share price and it hits the earnings. And that's what it's done for Judges. And that's really not the problem, or not why I want to talk about it. The reason I want to talk about it is I was really looking forward to this meeting, seeing a company that I don't think I've seen before, actually, it has to be said, because it's only really grown up in the last sort of 7 or 8, 9 years, and see what it was all about, because it's done a brilliant job. And what I found was a management who were deeply unnecessarily apologetic about the share price performance and the earnings performance, to the point of sort of self-flagellation almost. But a brilliant management team who had a lot to say, were terribly excited about the way they work, what they do, and they've got a good story to tell in front of a group of analysts who are very good analysts, all got deep industry expertise. But really, we only sat there and talked about one issue. Surprise, surprise, it's Geotech. What's going to happen with that over the next 12 months? What's going to happen with that over the next 18 months? What's going to happen with that over the 24 months Can we get more than one contract a year? Are we going to get any contracts next year? And you think this is not a functioning market when we're only talking about a very, very tiny thing here.
Always love a profit warning. This sounds like a
Always.
great opportunity because, of course, sell side will be, I hate to say, side blinded by the last print.
Yes.
And see a tree and they've lost the forest.
Exactly. What do I know about judges? I know
Yes.
geotech. I know about drilling things out of the ground. I know about testing. And the story continues, and it takes a while for
Yeah.
you to get back through the other side of it to the point where geotech, it's an issue. You have to talk about it, but it's not the big issue. We're back to the long-term story of how judges grows. And the way it grows is through doing these acquisitions and some organic. But at the end of the day, it's deeply frustrating because I thought this is just shallow. It's not quite working in terms of where the market is functioning.
Yeah, but this is one of the great instances, and excuse me for saying this, the investment community will get it right and sell side will get it completely wrong, where sell side will be ignored. These are one of the times when you benefit from a profit warning. Share comes out,
Oh, yes.
hot money is flushed out, and you know exactly where the underlying story is headed. And I hate to say, not all contracts are won. You miss some. The important thing is to have more contracts to bid for. But the business must be hard to forecast anyway.
Well, up until geotech, I think it wasn't that difficult because it was lots of irregular waves, should we say, and you stack them all together and it becomes a smoother story. And as the business grows going forward, that will help wash geotech through, as it were.
Very good. Can I ring the bell that says Ian has identified deep value?
Yes. Well, the problem is in the UK market, we have this situation where, as it draws me onto what I was writing out a few weeks ago on this VCs and listed microcap funds.
You love your controversy.
Well, I don't think it's actually that controversial. Really. I don't think I've actually ever said anything particularly controversial. It's just that if you put it on LinkedIn, it would be controversial because there's a difference between reality and LinkedIn. We all know that. It's like believing that every stock is a buy. Strangely enough, it isn't. We'll have a pause for a fundamental fact.
Stop, you're shattering reality as we know it.
Wasn't really what I was actually looking for when I put this blog together. What I was thinking was actually we've got these VCs and we've got these smaller companies, fund managers,
Yeah.
and they invest in risky businesses. Can I draw a line between the two? Can I try and get some kind of understanding? And one of the differences between the two is that when we look at the VC funds are in preference shares. So that is an inherently different, less risky structure. So that's one of the ways that they deal with their risk.
Yeah.
The businesses that the microcap funds are investing in, they are typically slightly more diversified and they are typically older companies because they tend to be older companies because they are listed companies. And then the big difference, I think it's a bigger difference having run numbers, is for the VC, the due diligence and investment process, well, there's lots of it. They use accountants, auditors, lawyers, a plethora of other advisors too. They use their contacts. And if they've been invested for a while, they may well actually have board representation too. And of course, for some of those advisors, they will be reporting to the VCs as investors. For the small cap, microcap, well, where do we look there? We look at the admission document, the prospectus, the audited accounts, the fact it's passed through in somewhere other than nomads, brokers, FSA, UKLA, AIM regulation, what have you. And then onwards, we have the equity research and the final hurdle, the time spent by the investors themselves, all adding up to what I suppose as tech analysts we might refer to as the due diligence or investment decision stack. So looking back at the results of that analysis that was done a few weeks ago in my blog, for the more conservative research-driven microcap fund, putting a preference share structure over it was of no benefit to the NAV movements over time. But for the diversified microcap fund, which, it has to be said, has got a long track record in terms of process of having worked effectively, but also an approach that is less reliant upon internal and more reliant upon external resources and systematic assurance, shall we say, the preference share structure tempered the NAV movements significantly. In fact, the NAV movement ended up very similar to the NAV movement of the relatively early stage VC fund we used as a comparator. So how come we have public listed companies then where the EV movements suggest that they are as volatile as early stage VC invested companies? This is not right. Where has the risk and the volatility come from? It's not the age or the sector profile, because of course these companies are listed and they've been going for a while, so that actually suggests a lower risk. The difference would appear to be in the due diligence or the investment decisions stack. This is an interesting situation, and we have to consider, how does that tie in with the demand for more retail investor involvement in the market, and the idea that we might be asking the great British public to put its hands in its pockets. We have to ask ourselves, what can we do to make this microcap early stage float issue safer?
Well, the solution in that case is prefs, because that's how we will address the divide between both of these markets. Institutional investors want one class of share. They don't want many different classes of shares. Could you solve this through prefs?
No, I don't think it could be solved by prefs, because at the end of the pref, you still have to convert it to an ord.
Yeah.
And then you have this sort of situation is, well, am I just going to sit around and wait for the ordinary to turn up? If owning the pref on the float and then having 2-3 years before it converts into an ord, you're just going to have people sitting on prefs, because no one's going to get involved. They either get involved at the start or they get involved at the end of the pref process. It's a complicated thing to try and work out what the pref is valued at or what it's really worth. Or are they just going to sit and look at a pref and say, well, it's either paying the money or it's not paying the money?
So is the solution from improving DD? Is it a change attitude to risk? How do you make it better?
The issue is about improving the process from how does this company come to market? How do we get the information? If we look at where does it go for DD, it goes through the DD at the broker in terms of, is this good enough? Does this tick all the boxes? It's a good enough process.
But you've also raised a massive red flag on the basis of being evidence-based and saying, well, I went along to judges. Everyone is looking at this very small bit of the underlying investment story and getting completely carried away, missing the 90% of what they should be doing. And then is that the right constituency to give them more DD capabilities?
I don't think there's any issue about the capabilities of the analysts in the room. They were almost just sitting there going, I know I could ask this question, I could ask that question, I could ask this and that and then. And you almost felt that the management were thinking, come on, hit the ball back over the net. Let's have a rally. And it was most peculiar. So the abilities are certainly there. Everything seems to be washed out to the extent that everything is done to satisfy a process called flotation or a fundraise. And the due diligence, investment appraisal, fund management decision, it's just become watered down, diluted. There has become no backward and forward to it. No one is paying for it anymore.
So correct, nobody is paying for it, yes.
There's no situation in which, how does a fund manager complain to a broker about the forecast? How do you complain that everything has gone horribly wrong? Well, you stand back and you don't participate anymore. How do you stand back and not participate from the game? You're in the game. You have no choice. You are a fund manager. I mean, it's bad enough for a normal small cap fund manager, and it's tough for the microcap guys, and it's an absolute nightmare for the VCT people. I mean, it makes it worse and worse. But I think the biggest problem is it's not so much the thing itself, because we talk about this problem again and again and again, and we don't talk about names because it's not names, it's not people, it's not things, it's not companies, it's the system. The system is clearly not working. It's created what's generally described as this Gresham's law or Akerlof's lemons, where the market doesn't do due diligence. If the market isn't doing due diligence, who is it that is going to be attracted to that market? If you want to sell your lemon, you're going to sell your lemon on that market that does no due diligence. If you've got a good thing that you want to sell, you're going to sell it on the market that does full and proper due diligence, because they will pay the full price. And it's not just about the new companies either, because of course this lemon problem drags down the prices of all the companies on the market. And we can sit here and everyone says, oh, what a terrible nightmare. All these PEs come in and they've got these tax advantages, and they come in and they pay more than we do for these companies that we've been looking at for years. And we've been doing, 4 or 5 hours a year on these companies. Well, the PEs come in, they do hundreds of hours of due diligence on these businesses, and they pay a 30% premium. Well, I think the message is quite clear and it's well understood. It's just not a particularly popular thing to say, even though we do all know what the situation is.
There's another side to it as well. Absolutely, they do pay that premium to the undisturbed price. However, they tend to swoop when the markets are particularly soft. So they're typically paying a 30% premium on a suppressed share price anyway, which more often than not is suppressed because the guys have just had a couple of profit warnings, say.
Yes.
So it's gone down. So then they swoop. So they're not just paying a 30% premium because they're nice people.
They have a long-term view because they have the information. They built this information up over time.
Yeah.
And although the capability is there, the functionality is there to provide research, to allow fund managers to go and access it.
And adding into that, you could say the exact same thing about retail investors, an increasingly important constituency in terms of UK assets under management.
Exactly. If you can get that body of people, body of money investing, but you have to make sure it's investing knowledgeably. There's no point in opening the doors and saying, hi, boys and girls, come and invest here, if you haven't sorted it out beforehand. All that's going to happen is you end up with a plethora of nightmare profit warnings, allegations of mis-selling, all the things that we know that fund managers take as part of their daily grind and accept as a risk of having a portfolio. And we know that the private punters aren't going to be building properly constructed portfolios. They're not going to be producing a risk assessment. They're not going to be saying, well, actually, my balance between large cap, mid cap, small cap is this. My exposure to oil is this. They are running on stories.
Ian, you told me that all I needed to do was plant the 5 beans in the ground and tomorrow I'd have a tree. I feel aghast. Nothing. I wanted to chat to you for you to solve the problems. All you've done is you've left me with more questions and doubts.
I don't think there are any problems that are particularly difficult to solve, are they? We know what the problems are. We just don't like to talk about them. And if you do talk about them, there are done so easier to solve.
On that bombshell, the world seems a clearer place. Ian, thank you so very, very much for your time and thoughts.
Group counselling for small cap, yeah.
Brought to you by Progressive Equity.